because the IPO has opened for subscription today, and the company is looking to raise around 600 crore rupees through fresh issue. Rima, we will speak to the management also in just a bit, but take us through a little bit about the company. What do they do? What is the IPO looking like?
Well, this is an electronic manufacturing services company, EMS. So its peers are the likes of, Dixon, Kane, Syrma, SGS. So they're basically creating component parts which caters to the aerospace and defense and medical technology, right? So typically what used to happen, this used to be a subsidiary of Cyient. So Cyient also caters a lot to the aerospace vertical. So the aerospace client would come up to Cyient and say that, this is our problem, this is what we need technology for. But they also needed certain components, which used to get manufactured by DLM. So this is why DLM got housed, manufacturing business got housed in Cyient, because they had common clients, like an aerospace, company client or a defense company client, which Cyient used to service from the technology aspect, and DLM would manufacture a circuit board for them, a black box, which you require in an aerospace company. So more than 50% of its revenues comes in from aerospace as well as the defense vertical, but the other businesses include medical technology and industrial. So some of their big clients include a Honeywell, a Molbio Diagnostics, or an ABB. So these are large clients. Now the advantage of something like being in EMS right now is that the EMS industry in India is growing very, very fast. Now, according to some estimates, the size of EMS industry in India was $20 billion in 2022, and that's expected to go up 4x to $80 billion in 2026. So the EMS industry itself in India has a lot of tailwinds, and particularly because this company caters to aerospace and defense, there are very high entry barriers. There are very stringent quality and qualification requirements. So not anyone can come out and say that I'm going to manufacture a defense or an aerospace part. So in a way, this company has a niche, and this is how it's differentiated from the other listed companies in India, which cater more to the consumer side. Yes, they also have an element of defense and aerospace, but look at the revenue contribution, right? We're talking about nearly 60% coming in from aerospace, defense, medical technology, also very, very scientific, precise requirements needed. And that's where, Cyient DLM, belongs to.
And I guess, Rima, just to sort of come in over here, the market has started differentiating between EMS companies now. There are ones that are only into the pure manufacturing part of it, and then there are the design companies. And we've seen that play out in terms of, the likes of Kane, Syrma, Avalon. A couple of these companies that also do designing apart from just the pure execution and manufacturing. Those stocks have run up through the roof. So this is going to be a very interesting IPO to look at, to see in terms of what the market appetite is going to be, what the listing itself is going to be like. But it's a hot, hot space. So you've established that. Also, tell us a little more about maybe the company's financials, how it's kind of been doing, and the other important aspects that we should look at.
Well, as you pointed out, right, whether the company designs or is it just going to be following what the clients want. So the services provided by the company come in two categories. One is build to print, which basically means the client provides the business. They will, the client will provide the design, everything that they need, and this company will only manufacture. But increasingly, they want to get into build to specification, which is called B2S, where DLM itself will design first. The company will only tell them, these are my requirements, DLM designs, and then it will also go ahead and manufacture. And I'm guessing the margins in build to specification would be higher than just build to print. But quickly, about the financials then, and those will come up for you. 832 crore in terms of revenues last year. Margins are about 10-11%, and this is what it's been for the last 2 or 3 years, for which we've taken out the numbers. Another good part about this is that the export contribution has been going up. So if we have that number, in FY21, exports were 37%. In FY22, it went up to 45%. And in FY23, it's close to about 60%. So the share of exports, has been going up. I guess FY22 is an anomaly because of COVID, and that can skew, the numbers. But generally, in the last 2 years, as you can see, the share of exports has been going up. And finally, our colleague Surabhi has very, nicely given us the peer comparison in terms of valuations as it compares to Dixon, Kane, Syrma, SGS. So let's get that up for our viewers as well. Generally, because these companies have run up, peers like Dixon, Kane's are very, very expensive. But that's the picture.
Look at those valuation multiple, 90 something times.
But this is trailing, we are looking at almost for most companies, we are looking at forward, which is not FY24, it's FY25. And these companies are fast growing. but the trailing numbers, it's still, I'm sure, a pretty expensive
Pretty
space.
hefty over there. Okay, so let's see if we can actually get the company's management in. Cyient DLM's chairman, Krishna Bodanapu, joins in to talk about, of course, the business, the outlook ahead, and just, how they're sizing up the opportunity over the next couple of years. Thanks very much for taking this call, sir. So first things first, the market's very intrigued and interested in the EMS space now. So you have the tailwinds, the sentiment tailwinds on your side for sure. But, as we were just discussing, help us understand how much of your business right now comes in from the design side, the build to print versus build to, I think, specifications, as Rima is telling us. And how do you see it going forward? What's the margin in these two segments? And do you see yourself doing more of the design work, say in a year or two from now?
Very much, and good morning. The business split right now is primarily built to print, which is essentially somebody else has done the design and we are the contract manufacturers. That is the overwhelming majority, 99% or so is that. We continue to see that happening for the next year or two. But having said that, the whole intent is going forward based on how the pipeline is looking and based on how the order book is shaping. We see that we will have a lot more design control, or we will do a lot more build to spec work in the next couple of years. Again, the way the nature of the industry is that, again, won't be a very large portion. We expect that to be in the 20-25% in a steady state. But that's the number that we are working towards. The margins on the build to spec are significantly higher. For the simple reason that when we design something, we have a lot more control on what parts do we use. Therefore, we can optimize based on the cost of parts, availability of parts, availability of manufacturing processes, and so on and so forth. So we believe that as the build to spec becomes larger, we also have a much larger runway on margin, or a lot larger headroom on margin. So,
Mr. Bodanapu, can you tell us what's the delta between both the segments? I mean, we understand it's pretty logical to understand that your build to specification will be a value add, much higher margin business. What's the difference we're talking about?
It's about 3 to 4% higher.
Okay, got that.
Sir, this is Rima here.
Yes.
Yeah.
Go ahead.
No, because the number is 3 to 4% higher because ultimately manufacturing will take in a large portion of the revenue. And therefore, while the purely on the design, the margin is significantly higher. But if you take the weighted average, it will be 3 to 4% higher.
Got it. So margins of build to specification are 3 to 4% higher than your margins of build to print. But as of now, 99% of your revenues comes in from build to print. Sir, can you tell us why has it been so difficult for you to scale up build to specifications? There is a reason, right, why it's still contributing a very small portion. There may be headwinds. Maybe the client doesn't want to give control in areas like defense, aerospace. Can you tell us the reason why it's been difficult for you to scale it up until now? And what's going to change on that front?
We believe that there's two reasons that it's been difficult. One is the intellectual property, which is essentially what the client owns and controls, is where they don't want to do more build to spec because that will mean that giving up a lot of that intellectual property control to a supplier. And that's the reason why they have not been doing that so much. The second reason why also clients have been doing this is it's just a matter of time thing, right? This industry or the industries that we work in are quite mature. And a lot of what we're manufacturing has also been designed, many years ago. It's really iterative and it's only newer versions of the product still. But having said that, with where things are headed, with how much, with the semiconductor industry, the growth there, with newer chips being available, etc., now we're at an inflection point of how some of the technology and the design will change. In this change, again, I'm also saying it's only going to be 20% in steady state, because even in this change, we believe some of our clients have actually started to give us the design parts, and that's the beginning of these build to spec. So I think there's a fundamental change in the industry where clients are willing to look at, for certain components, again, not necessarily the core intellectual property, but for certain systems and subsystems, they want somebody who can take the ownership, and that's where Cyient DLM, of course, backed by science engineering capability, would come in.
Okay, got that. Since you're talking about these roadblocks, what is the kind of timeline that you see in, being able to increase this? Because a lot of what you mentioned are not issues which are about to go away very soon, right? At least in, say, the defense vertical or maybe medtech. I get that you're seeing maybe some pickup in the design part of orders for semiconductors. But what is the kind of timeline that you expect? Say, in 2 years, how much do you think this could go up?
So within 2 years, also this number won't change significantly. The design to specification part will change in the next 3 to 5 year time frame. If you look at the the way that we're building our margin bridge is we are at about 11%. Natural number should be 12%. We've made a lot of investments in the last year, especially with leadership, with supply chain, with technology, etc. So we should come back to that 12% within the next 12, 18 months. Then we have a runway based on further supply chain optimization, utilization, given that we're running at about 1/3 capacity, etc., etc. There's a number of levers that are there that will help us to get to 13 to 15% margins in the next 24 months. And really, the headroom that we have, the delta that will come in, is really beyond that. So we have a clear roadmap of how we wish to execute in the next few years. But we're also focused on the longer term, because really to have a long-term sustainable business and the margins that we aspire, the build to spec has to kick up. But that's not what we're counting on in the immediate term.
So just to get the numbers right, 12% margins in the next 12 to 18 months. And in the next 24 months, when do you hit 15% margins?
It'll be in the next 2 to 3 years. And again, I'll keep the commitment to 13 to 15 because it's very difficult to plug to a number.
And the two drivers for this will be, one, increase in capacity utilization, because you're only operating at 1/3 capacity. And the second one is the investments the company has already made, right?
Absolutely. And the third is, I'd also say the pricing of the order book and where the newer orders have already come in.
So the newer orders are coming in at higher pricing? At a higher price point? What about this acquisition? Because you're raising money to do an M&A too.
So our objective is to build capability. From a capacity perspective, we're doing quite well. But if you look at where the market is and what our customers are expecting, they're also expecting a lot more globalization in the manufacturing supply chain. They want us, their proximity to where their end manufacturing is becoming that much more important. Certain special processes, certain special capabilities are important. So we are looking at, and again, I don't have a definitive answer on when or what, but our intent is to fill that capability gap, not the capacity gap, because there's enough capacity. So it's the capability gap that we're looking at.
Okay, all right, got that. Good talking with you and getting a sense on the business, and we look forward to connecting further in the future, and let's see how the market takes the listing.